effective asset allocation strategy is a key to your investment success. So, now we are going to see various asset allocation strategies that you can apply in your investment portfolio. To get in depth understanding, we have our investment expert Mr. Satish Prabhu with us. Satish, help us understand various effective asset allocation strategies.
Now, there are various types of asset allocation that you can do. You can do tactical asset allocation. You can do age-based asset allocation. You can do constant weight, and you can do a dynamic asset allocation. And we look at each of these types. Don't go by the terminology. The terminology may sound technical, but we will look at simplification of how simple these terminologies are. The middle two terminologies go by their names. Age-based asset allocation is a very simple allocation that today, if you're investing, say, in say a pension scheme may tell you that at a lower age, have more money in equities. For example, if you start investing for your retirement at the age of 25, the asset allocation may tell you that at the age of 25, you need to have 90% money in equity and only 10% money in debt. And as you grow older, like at 26, it'll tell you have 89% money in equity. At 27, it'll tell you have 88% in equity. So every year, it reduces the equity allocation and moves your money to debt. What it is trying to do is that it is trying to reduce the risk in the portfolio as you age. So age-based asset allocation is basically where it gives you higher equity allocation when you are younger and a lower equity allocation as you grow older. And a constant weight allocation is where the weight of equity and debt is constant. So if you decide that I want to be 50-50 in equity, it will always stay at 50-50. It will not change, but it is a fixed weight. It tells you that I will invest 50% in equity and 50% in debt. I will invest 60% in equity, 60% in debt. So that is a constant weighted asset allocation. Now we look at two other methods of asset allocation. One is a tactical allocation and one is a dynamic asset allocation. Now, a typical strategic asset allocation or a static allocation is what you see on the left side of your screen, where equity is 45, debt is 55, and the rest is in cash. I think there's a calculation error there, but it should have been equity 45, debt 45, and cash 10%. But this is how a static allocation works. Now, over that, if you want to add a tactical allocation, now I'll explain to you what is a tactical allocation. A tactical allocation is when at the spur of the moment, looking at the external situation, you want to take a higher exposure to a particular asset class. And I'll give you an example of both equity and debt. On the day the lockdown was announced, or in the month the lockdown was announced, which was March 2020, equity markets fell by almost 40%. Now, an investor who has seen the markets over the years, a prudent investor, will realize that the downside at 40% is far lower. And that is the reason he takes a tactical call that I will put some more money now in equity. I will put a lakh or two now in equity because the markets have fallen by 40%. I'll give you another example. Suppose some event happens because of which the markets fall. The Sensex falls by more than 1,000 points on a day. On that day, you will realize that let me put some more money in equities. And these are tactical calls that you take for investing in equity at the spur of the moment. Basis that situation, you decide that let me invest more in equities. Again, it could be overall markets, it could be a sector, in which you want to take a tactical call, but largely people take a call on the markets. Similarly, when you look at debt, uh, the NAV and the interest rates move in opposite directions. So if you want to make some returns in the debt markets, you have to wait for interest rates to fall from the peak. Now, nobody knows the peak. Okay, generally people don't know the peak. It is assumed that today we are at the peak of interest rates. There may be a few more hikes left, but we are nearing the peak of interest rates. Whenever those interest rates start falling, you will see that medium to long-term debt funds will start doing better. So people start taking tactical calls and putting some money in long-term debt funds, typically government securities funds, to make those returns. Now, these things are very difficult. You need expert advice, but I'm theoretically explaining what is a tactical asset allocation. So people use tactical calls to make some higher returns in the markets, whether it's debt or whether it's equities. So that is tactical allocation. And what is dynamic asset allocation? This is something which is more popular, and where you find that I will not invest a fixed amount in equity or debt. I will change that amount basis the market situation. Now, can you do it on your own? It is very difficult to do this on your own. So for which mutual funds have designed a fund called a balanced advantage fund. A balanced advantage fund helps you invest in equity and debt depending on the market situation. Now, what do I mean by market situation? Now, equity markets, whenever they are very highly valued, and the valuation of the market is determined by what we call as the price to earnings ratio. So whenever the market valuations are high, I will invest more money in equities, or the fund will change the allocation to invest more money in equity. And whenever the valuations are low, whenever the valuations are more, I will invest less. And whenever the valuations are low, I will invest more. So in this case, in this graph, in this slide, you will see that on the left-hand side, the valuations are very cheap. They are low valuations. So the tendency is to have more money in equities, because from here on, the markets may start to rise. Like I said, it is very difficult to know what is the bottom of the market or what is the peak of the market. Very difficult. But how funds do it is that they use valuation methods, which is the price to earnings or the price to book value, to determine the valuation. So higher price to earnings and book value means higher valuation, in turn means lower equity in the asset allocation. So on the left-hand side, you find that the valuations are cheaper. That's the reason you put in more money in equity. On the right-hand side, you find that the valuations are very high and you invest lesser amounts in equity. When the valuations are high, the markets are expected to fall. And to prevent that fall, you put in lesser money in equity. Now, as I said, it is very difficult to do this manually. And that is the reason balanced advantage funds are preferred when you want to do asset allocation on your own. So if you want to do debt and equity allocations on your own, a balanced advantage fund does it for you. And this is the illustration of how the asset allocation moves. Two things about taxation that you need to remember. Whenever you change your allocation from equity to debt, remember, when you do it manually, there is a tax element to it. If you are selling debt, then again, it depends on whether the debt you have sold, is it held for less than 3 years or more than 3 years? If it is more than 3 years, you get indexation benefits. And if it is less than 3 years, you don't get those indexation benefits. Similarly, in equities, if you invest for more than 1 year, you pay long-term capital gains tax, which is 10%. And if you own equity for less than 1 year, you pay short-term capital gains tax. So you have to remember these tax elements before you make switches from equity to debt, depending on the market scenario. Now, can you save this effort? Can you save the taxation effort? Yes, you can. A balanced advantage fund basically doesn't need you to pay tax when it changes from equity to debt. It doesn't need to do that. It is a pass-through, and within the fund, when it changes from equity to debt, there is no tax element that is in. Only when you sell the units of the balanced advantage fund do you need to talk about tax. Till then, whenever you look at the screen, which is higher equity, medium equity, and lower equity, you don't need to pay tax. You need to pay tax only if you sell the units of the balanced advantage. So remember, there is a tax element that is involved whenever you change your asset allocation on a manual basis.
Thanks for your detailed answer. If you have any doubt regarding this or any other financial or investment decision, don't hesitate to book an appointment with our financial expert. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like, and if you are new to our channel, please do subscribe.